Well, for an early look at our market and what we can expect to see here, we're joined now by Evan Lucas from IG in Melbourne. Evan, welcome to the program this morning. It looks like this massive sell-off that we've seen in tech and biotech seemed to have a bit of a reprieve, but now it's resumed again. The NASDAQ down nearly 3%. Where will this end and what's it going to mean for our market?
Yeah, good question on where this will end. I think at the moment what you're seeing is a bit of a buyer's strike going on over in the US. So last night the NASDAQ made another record it probably didn't want to sort of revisit, which was the single worst trading day it's seen since 2011, going in coupling in hands with the start of the week when it had its worst three-day slide as well. So it does look like traders are going back to that whole idea that valuations in those really high growth stocks are being questioned again. We are moving into earnings season over in the US, and that needs to be put into perspective. We are certainly watching that very, very closely. JP Morgan will be the one to watch tonight. They are coming out around about 9 p.m. and they will be the ones that will really sort of put a bit of a perspective on how earnings season will be. Expectations are for growth of around about 1%. So it was a tough quarter considering what was going on in the US, and we may see inline results, but already Ocala has showed that they managed to get through the last quarter unscathed. So that may sort of put a bit of a floor on it, but having a look at what is going on those bias techs, it does show that maybe after 6 years of a really big, strong bull market, that valuations are starting to sort of put people into their places and sort of position themselves for that. So we'll probably experience it as well. There's no doubt we'll go back. Again, watch those sort of online plays, things like REA, Seek, car sales, also put in there TPG. Incredibly good companies, but do look on the fundamentals a little bit overvalued, and they may see a bit of pressure again as they did at the start of the week.
So, Evan, I'm seeing two trains of thought on this. The first is this is a bit of a route that will be restricted to tech and might have minor flow-on effects. The other is this could be the start of that stock market correction, stock market crash. Where do you stand in terms of those two spectrums?
I would probably say, before we go anywhere with the word of crash, I'd probably say correction is a possibility. It's not a problem. You've got to look at the S&P. It's now up 184% since that 2009 low. So a correction is not a bad thing. Last year the S&P had a year that it hadn't seen since 1997, and that was a 32% increase. So having a pullback, having a 10% correction, when you look at that on that kind of time scale, is not an issue. It is something that's probably healthy for the market as well. It means that there is growth still being there, and obviously people are taking profit, understanding how their strategies work. So I would say that yes, if we do start to see a pullback, maybe earnings season doesn't live up to expectations, and we do see that, that's not a bad thing to see, considering how strong the S&P has been and how the US markets as a whole have been. So that's my perspective. Again, a lot of people are different to that, and I actually think that there is still a lot of interest, because at 18 times earnings, that may seem expensive, but realistically that's something that most people can sort of handle. So there is still certainly upside potential there, and even some of the major bears are saying that 1950 on the S&P is not a hard thing to make a case for. So I do sort of point to those sort of things that yes, we may see a pullback, but I don't think it's going to be a crash or a rout like we saw probably in 2011 and then back to 2008 and 2009.
Now, if we look at China data, that did show a bit of a collapse in imports. What does that mean for commodities and also producers as well?
Yeah, that's the one that I think from an Australian-centric point of view we need to be really aware of. Yesterday's trading was quite interesting for that perspective. So that 11.2 contraction from a 10.2 uptake the month before was a really big turnaround, and the inflation change and also the change in commodity prices really did drive that import collapse. So watching iron ore, it dropped 8.8% in terms of what the Chinese were buying into. Copper was also down around about 7%. Coal was down around about 8.8%, and they are the three major exports that come out of Australia. So that really did reverse the mining space quite heavily yesterday, and I think you may see that really starting to filter through. Again, we now therefore need to see what happens with what Li Keqiang said yesterday about we're not going to see fiscal stimulus, but we do want domestic demand to increase. So does that mean more infrastructure projects being brought forward? And until we sort of hear his talk and what the central government is going to do, I think that's going to really weigh on people's perspective, considering the mining space and the material space as a whole was the reason since that March low that the ASX has really driven itself forward. BHP was outperforming that sort of change by about 9%. So that is something I'm a little bit interested in watching today. I think you may see some pullbacks there. We are going to go backwards, as I said before, and I think you may see some profit being taken off the table, considering how strong those players have been. So watching BHP, watching Rio FMG as well, they all may come back. In saying that, iron ore, however, on the spot price has held up overnight, so that may put a bit of a moderation into it, but that will be where I'll be watching in terms of any sort of moves today.
All right, Evan, thanks for the update this morning.
Thanks, Nigel.